All right, today we're going to pull back the curtain on a company's finances and look at something that honestly is way more real than just profit. We're talking about the cash flow statement. It is hands down the best tool out there for seeing where the money actually goes.
So let me throw a puzzle at you. This is one that trips up even some of the smartest investors out there. Picture this. A company's profit report looks amazing, right? They're supposedly crushing it. But their bank account is bone dry, empty. How? How is that even possible? It sounds like a total paradox, but you'd be surprised how often this exact scenario plays out.
Well, the answer, the secret to solving this puzzle, is hiding in plain sight. It's in a document that completely cuts through all the confusing accounting jargon. A statement that only cares about one single thing, tracking the movement of real, hard cash. And that document, of course, is the cash flow statement. Look, the simplest way to think about it is this. It's basically the company's bank statement. It is the unfiltered truth. It tracks every single dollar that comes in and every single dollar that goes out. This isn't about theoretical paper profits. This is about real money. Here's probably the most brilliant and simple way to think about this. Your salary slip, it might show this big, impressive number, right? You could call that your profit. But what's the amount that actually hits your bank account after taxes, insurance, all that stuff is taken out? That is your cash flow. See the difference? One is an idea, the other is cold, hard reality. So, okay, how do we actually read this thing? Well, every single cash flow statement tells a story, and that story is broken down into three main parts. You can think of them as the three main paths that cash can take as it moves through a company. And trust me, understanding these three sections, that's the key to everything. So here they are, the three big chapters of our cash flow story. First, we have operating activities. That's the cash coming from the company's core day-to-day business. Second, investing activities. This shows us how the company is spending money to build for the future. And third, financing activities. This is all about where the company gets its funding. So let's dive right into that first one. All right, first up, and you could argue this is the most critical section of them all, business operations. This part of the statement answers the single most fundamental question you can ask about any company. Is its core business, the very reason it even exists, actually making money? So what does this include? Well, this is the cash that comes from the very heart of the business. We're talking about the cash that comes in from sales, the payments you actually collect from your customers, and then, of course, you subtract the cash you had to spend on things like inventory and all those day-to-day operational expenses. And right here, you can see the difference between green flags and red flags, a healthy business versus a sick one. A huge green flag, seeing that operating cash flow is consistently positive. That means the core business can support itself. But a major red flag, when a company has tons of sales on the books, but the actual cash isn't coming through the door, that is a textbook sign of trouble ahead.
And look, this is really the crucial point here. A company simply can't survive long-term by just borrowing money or selling off pieces of itself. If its main business, its core reason for being, can't generate cash, well, its chances of surviving in the long run are pretty slim.
Okay, let's move on to the second path, future investments. This section is all about looking into the future. It tells us exactly where a company is placing its bets. How it's spending money today with the hope of making a lot more money tomorrow. So what are we talking about here? This includes things like buying new machinery or equipment. That's a cash outflow, money going out the door, or building a whole new factory. But you can also have cash inflows, like when a company sells off old assets it doesn't need anymore. It's really all about the buying and selling of stuff that's meant to last a long time. Okay, now this part can feel a little counterintuitive at first. A healthy pattern here is often a negative cash flow. And you might be thinking, wait, negative is bad, right? Well, not here. A negative number means the company is actively spending money, investing in assets for future growth, which is exactly what you want to see. The real warning sign is when a company is consistently selling off its assets. That might mean they're in a tough spot and just need cash to survive. And that brings us to the third and final piece of our puzzle, funding and loans. This section shows us exactly where the company is getting its money from. Is it from banks, from other lenders, or is it from its own investors and shareholders? So this is pretty straightforward. For example, if a company takes out a loan from a bank, that's a cash inflow. If it issues new shares to investors, that's also a cash inflow. On the flip side, when it starts repaying a loan or pays dividends out to its shareholders, that's a cash outflow.
It's all about tracking the money flowing between the company, its owners, and its lenders.
Now, what's really fascinating about this section is how the patterns here can reveal so much about a company's overall strategy. Just by looking at these financing activities, you can start to piece together a story about where the company is in its journey.
For example, you might see a growing company that's taking on new loans to fuel its expansion. That tells you one thing. Or you might see a stable, mature company that's paying out dividends to its shareholders. And a really strong company might be using its cash to actively pay off its debt. Each of these patterns tells a completely different story about the company's health and its strategy.
Okay, so we've looked at all three paths: operations, investing, and financing, one by one. But the real magic, the real insight, comes when you put them all together. This is how you finally get the complete story, the full picture of what's really going on. And this table right here, this is basically the key that unlocks everything. It shows you the typical cash flow profiles for different kinds of companies at different stages. The pattern of those plus and minus signs, think of it like a secret decoder ring for understanding a company's financial health. So let's just trace the story of a growing company. First, it's earning cash from its main business, so operating cash flow is positive. That's good. It's also investing heavily in its future, so investing cash flow is negative. And it's funding all that growth with new loans or by bringing in investors, so financing cash flow is positive. See that pattern? Positive, negative, positive. That is a classic growth story. But now, let's contrast that with a struggling company. Its core business isn't making any cash. In fact, it's losing it. So operating is negative. It's being forced to sell off assets just to stay afloat, which makes investing positive. And it's borrowing more and more money just to survive. That makes financing positive too. That combination, negative, positive, positive, that is a company's cry for help.
So here's the crucial takeaway, the one thing to always remember. Profit is an opinion, but cash is a fact. So the next time you're looking into a company, are you just going to look at the profit, or are you going to follow the real cash? Because that's where the real story is.
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.